Well, the big day is finally here, but we got some developments that we need to go over ahead of time, and we are seeing a change. One thing nobody's watching is what's going on with China's government bonds in the 10-year and how they're buying the heck out of them. Now, usually this is not something that we would care about, but we've been watching steel stocks, basic materials such as copper and gold, just continue to collapse. And every time we turn around, we're watching mainland China do things to spur investment. But this was after Golden Week, and this was after the one big push, what they were going to do in their finance ministry, and then the second big one. So we're watching mainland still sell their stocks, and we're watching some of these other pieces go down. And I do think that it's connected, and I do think it's worth talking about. Now, I want to go through a couple of headlines here because I think this is very important. China capital markets outflow hit record high in November after a Trump election win. Take a look at what's going on and the date on this. So he didn't just come out and say we're going to do more tariffs. So what the Reuters are linking to, maybe this is the reason for it, maybe it's not. But we know that this election win was going to lead to tariffs. As rhetoric at a minimum, but they're still talking about it back here. And this is where it gets super interesting. China broke this 20-year low back before Trump. They actually broke this in 24, where they couldn't even hold that. So it was way before Trump. But even if we want to say, okay, well, this is basically the Trump trade, watch when we get rid of the weekly and take this to the daily. Well, this is when we broke this level. So in other words, here's September, and then we just click right here. Well, it'd be better if it worked. If we click right here, we're going to have time to edit that out. December 5th right there, that's when we started breaking. So that new low after September, and then you kind of see how it played out. Yeah, we could say that that happened after the election, but we knew that tariffs were coming. So I don't think that's the reason. I think if you start seeing some of the economic data that's coming out, that's why this is going on. Now, whether we believe that's the reason for it or not, there's more headlines. When you start seeing stuff like this, China says no more stock market decline. Like, that's not going to work. Right? Like, that is not what everybody wants to hear. Like, we're just going to tell the stock market not to go down anymore. That's where they start getting into this place where, oh, you can't short, and they have their own rules, or they're going to lock up capital where people can't pull their capital up. And what we're seeing is signs of people kind of panicking a little bit here. And the amount of outflows not only are picking up, but the speed in which it's happening is ramping up, which is kind of crazy. And I'm just surprised that we're just not seeing more of this. Meaning more talk of this, rather. Now, energy stocks are dropping because China's slowdown is real. This was staggering, the statistic. International Energy Agency, IEA, expects China oil demand to grow by just 140,000 barrels a day in 24 versus 1.4 barrels in 2023. So they're basically saying that IEA is saying that you have a 90% drop. We were expecting it to grow by 140K when we were at 1.4. That's a 90% drop. That is absolutely huge. And I don't think people are getting this on the energy side when they're looking at this. It's actually very good for other countries that want energy prices to drop, but it's not very good for China. And this could have ramifications. Now, these charts were fascinating, and if you're in the community, you may have seen a couple of these I'm going to show before, but this is when China joined the World Trade Organization, and the U.S. share of global GDP did nothing but drop. So let's say that we do tariffs, and let's just say Trump does tariffs in some way, or something else that lowers China World Trade Organization. Well, not only does China currently have issues, but what happens if they start losing their share of global GDP? I think that's where it gets interesting, because global manufacturing over there, from when this happened in 2000, when China joined the World Trade Organization, you could see where we were as a U.S. share of global manufacturing. And he's talking about bringing U.S. manufacturing back. Look at where we are now, where we're at roughly, it looks like 16%, and where you were, you got cut in half. I don't think that any of this is actually being taken into account. Now, obviously, I don't think we're going back to here, but I do think that there's going to be some give, which takes us into this. If you look at Hong Kong Official Residential Property Index, and this is their official property index, if you look at this and just say, okay, well, where are we price-wise? Well, you're back to 13 or 14. And again, I think this is really super important to get, that you're right around that 14, 15 level. You're at decade lows, and there's no sign of this bottoming. So we're seeing that wealth transference out of there, and we've been seeing it for some time. Point that I'm getting at is there were already issues, and now those issues are exacerbating by the current administration that's coming in. Now, where am I going with all this? I think it's really important for us to understand a couple things. When we look at what's happening, we have to understand when we say China, we're looking at the second largest GDP in the world. And if they slow down, Europe slows down. If Europe slows down, US slows down. Everything slows down. So this is where it gets, to me, super interesting. Now I'm just going to leave this up here because I don't have time, but this is CME Fed Group interest rate, CME Fed Watch tool right here. If we look at this in December, you can see there's a 97% chance of a rate cut tomorrow. Then we go out to January, and you just click on these. And again, this is a free site, 81%, 425, 450. That's after that they're looking at getting a cut, right? So watch this again, just so you can stay with me. 425, 450 is where they're saying 97. Then you go 425, 450, they're saying no cut. What will happen to interest rates, okay? What is going to happen to interest rates if China starts getting weaker and demand starts getting weaker? And I think that that's kind of the wild card here. See, we always think we know what's going to happen, and it's always something else that hits us over the head with an anvil. For example, if we watch the steel names collapse, and this is one of the reasons why that's happening, but we look at, for example, when we look at names like the steel names or X, for example, and we see how this is playing out, what we'll note is, oh, well, it's because of the merger, that's why they're all dropping. No, well, when we look at like Cleveland Cliffs, and that's literally, I'm going to say it, here it comes, falling off a cliff, like that kind of stuff we have to pay attention to. Like, why is that happening? Or Steel Dynamics. I mean, these things have no bid to them. No one's talking about this, or no one's really talking about why are materials dropping. Like LIN, for example, is a very large portion of that. But so is FCX, which is copper. So is SCCO, which is copper. They are completely and utterly imploding. Now, copper not so much because it's utilized for semiconductors and things along those lines, but steel's imploding. And you would say, well, why do you care and how does this affect us? Well, if these all of a sudden Cleveland Cliffs and these other organizations are not churning out as much as they need, or for whatever reason you have these US companies on the manufacturing side that start doing less, that means less work. That means less employment. It's all connected. So we have to pay attention to this and go, well, we think that they're not going to cut rates as much as they were going to, right? And then we saw this with the 10-year. Now, just stay with me for a second because this is leading to something that I think is very important. When we looked at the 10-year back in the day, and we said, okay, well, we're going to drop. This is where he said we're going to stop raising rates. You remember that Itchy gave that big speech. And then from there, we all said, oh, they're going to cut 7 times. Well, we didn't cut till September. And look at what happened after the first cut. We went higher. I don't think what people are thinking about is any kind of global slowdown based upon the issues that China is having. And so why we thought there would be 7 cuts here and why we thought there would be 7 cuts here, and just to be clear, this was the first cut after we started factoring that in. We're starting to say they're going to start dissipating the cuts. We're once again telling the market what it's going to do, and I think that's a mistake. And one of the things that we're seeing out of this is what's happening with the US dollar. So then you tie all this stuff together, right? We'll get more into this on Saturday, but I want to give you a heads up because as much as I tease Powell, he's on this stuff. Like, he'll know what's going on over there and how that's going to affect us, obviously, right? Let's just drop this line and we can see this range. I mean, we can all see that 2-year range that we're trying to bump our heads out and break out of that. But you watch that range and you have a strong dollar. And then at the same time, you tie it together with this. And I couldn't figure out for the life of me why we have a strong dollar and then we're watching the industrials drop. Well, we're watching the industrials start to drop because if the second largest GDP starts contracting more than is expected, which is what's happening, it doesn't matter. John Deere's going to have issues. Caterpillar's going to have issues. You know, Ingersoll Rand, any of these companies are just going to start coming in. You know, one of our favorites was FTAI. And I mean, this just became a ski slope. You know, you're down to levels that I'll make you laugh. You have down levels you haven't seen since September. But we haven't had large corrections in these industrial names. And that's the reason for it. So this is one of the reasons. When you understand this and you link it all together, you're like, that's great. What do I do with this? Well, this is what you do with it. We want comparative analysis on the markets and look at where the money's going. And what we're going to notice is the money is flowing into tech on a relative basis. Now, remind you, when we divide the NASDAQ by the SPY, we're looking at a relative basis. So when we see those sectors that are hurt, that are related to more global and more construction and expansion, meaning if your growth of oil, like we showed, is significantly less, then you're going to be doing less construction. Well, we don't have to worry about the industrial side of the business on the NASDAQ. We just have to worry about the chip side and the software side and the biotech side. So that would mean that when we're figuring out where do we want to put our chips, well, it's very clear that we're going to want to put our chips into the Qs more than the SPY right now. And if you use something like this over time, you'll see pretty decent value in it. And I think that's really important. I think it's very important for us to note that, for example, if we look at these little breaks right now, you can see it. Down, up, down, and then you're flipping, and then you're pushing higher. This is the kind of stuff that you want to pay attention to. This is the kind of thing for me that I always look for. Now, I will overlay stuff like this, and then after I overlay this, I will tend to use just a 55 to make sure I'm above it. And you can see they're all curling up, 12, 22, 55. That's what I use. You should use what you're comfortable with. But where I'm going with this is that we should be focused tomorrow on the pullbacks, and when we see those pullbacks based upon the FOMC, and remember, we have the 12 o'clock meeting, the 2 o'clock meeting, and then the 2:30 meeting. Obviously, you're going to have the notes, and then you're going to have the dot plot. Now, tomorrow I'm showing you this because tomorrow you're going to want to Google this and look it up. This will be released at 2 o'clock, and it's not the statement, it's the dot plot. Every quarter they come out with a dot plot, and this was the release 2 p.m., September 18th. When this comes out at 2 o'clock, save yourself a lot of time. Type in summary of economic projections right in and do the Google, and it will pop up, and then you will have it and be victorious. What you do is you look at the dot plot versus the last one. But what they will tell you is what it is, tell you about why they're doing what they're doing. Each participant checks where the information will be. This document is actually about, this one, if I look at it, 17 pages. Now, you can go through it and get a lot of knowledge out of it, but what do you care about is this. What you want to do is watch where they're at. So what these are is FOMC participants' assessment of where monetary policy should be, midpoint of the target range. So they come over here and you have your percentages, and you can see where they thought 24 should be, 25, 26, 27, and then the longer term. And what you're looking for is, do they start getting all together? Do they start spreading out more? Does this tend to move higher? So in other words, this is one way to look at it to really just kind of give you a little bit of a cheat code. If this is up from that dot and you're up over here, then you have someone that thinks that rates are not going to be cut as much. If you're spread out further, then you have a lot of people that are disagreeing. If everything is moved up like over the 4% line and you look at it really quickly, you're going to go, oh, they're definitely not cutting as much as people think. Now, what that could do is lead to reaction in the market. So if they're not going to cut as much as we think, what do we think would happen with that? Well, this is where you have to really wrap your noodle around it. The first thing you're going to think is they're going to sell the 10-year. That's the first thing that you're going to think about. And we had a 20-year auction, which is kind of interesting timing to have a 20-year auction ahead of this. But nonetheless, we did. And it didn't go great. So we already know that the 20-year didn't go great. How's it going to go if we think that they're not going to cut rates as much as we think they're going to cut rates? That's going to be a problem. One of the ways to do this is to look at TMF and then go, oh, okay, well, if they're not going to cut rates as much, well, TMF is probably going to break this level, and if it does, it's going to go lower. And then you would look and say, okay, well, maybe I should short that, or maybe I want to go long that. But you definitely want to look at this as an interest rate vehicle. If they're hawkish, meaning they're definitely going to cut more and more and more, or whatever way they're going to lean. I don't want to get into the terminology. Whatever way they're going to lean, if it looks like they're going to cut more or they're not going to cut, you could use this as a vehicle. The other thing you could use as a vehicle is TNA, because what sector and index, small caps, is most affected by? So this would be 3X, the bull fund. And then, of course, you have I think it's TZA is the bear fund, right? So then you would look at these and go, okay, I could use these as vehicles. If they're going to cut way more, I want to go long. If they're not going to cut as much, I want to go short. And then that puts you in line with what's going on with the regional banks as well, which are imploding. And you would expect this to what? You would expect this to drop unless they're going to continually cut more. So it's really going to be not only in the language, but what he's doing. And are we starting to see some weakness in the market? I don't know. I don't know if we are. If we look at some of these names, After hours, at the time recording this, that Tesla's down for the first time after hours and God knows how long. But you're down $7 or $8, and you can see this thing just kind of coming in a little bit. It is what it is. It's not going to go up every single day, right? We would think. But you are starting to see, like, are we getting exhausted? Are we getting to those levels? Will some of this stuff come in? I don't know. I don't know how that's going to play out. We're going to see tomorrow. I would expect light volume and then to see these names start to pick up. Is NVIDIA, is the selling exhausted? There's some signs of that. There's a little bit of a level right here that we seem to be holding. And I'm surprised that you bounced today. And you are seeing some movement in the SOX. And you know what else you're seeing movement in? I'll just leave you with this. You are seeing movement in the ESOX. You are seeing movement in the equal weight indexes. So that's definitely something to think about as well. That is it.